What if the system you believe protects your money was actually designed to trap it? What if every paycheck you earn, every loan you take, every tax you pay feeds a cycle you were never meant to understand, let alone escape? The truth is unsettling. Modern money is not a natural system. It was engineered, carefully, quietly, and once it locked into place, there was no exit door. This is the story of how central banks created a financial architecture so powerful, so deeply rooted, that entire nations now live inside it without even knowing how they got there. Before central banks, money had limits. Gold, silver, physical reserves, these kept financial power chained to reality. But industrial expansion, wars, and political ambition demanded something faster: flexibility without accountability. Enter central banks. Institutions like the Bank of England and later the Federal Reserve were created under the promise of stability. Behind the scenes, a new idea took root. Money no longer needed to be backed by something real. It only needed belief and debt. With this shift, a small circle of financial architects gained control over interest rates, currency supply, and national credit. What looked like economic management was actually system design. And once the blueprint was complete, the trap began to close. The original purpose was simple: fund wars and recover faster than rivals. Central banks were given authority to print money in exchange for government bonds. This created a relationship where governments no longer needed real wealth, just perpetual borrowing. Cause and effect followed. More spending required more money. More money required more debt. More debt required higher control. The cycle was born. Rise expansion of control as decades passed. The system evolved. Fractional reserve banking allowed banks to lend money they didn't actually possess. Credit expanded faster than production. Prosperity appeared to surge. But every expansion carried a silent cost: compounding interest. Entire populations became dependent on credit for housing, education, healthcare, and survival. Economic growth became impossible without debt. The escape route closed even tighter. Breaking point: when stability became illusion, then came inevitable crashes. 1929. 1971. 2008. Each time, central banks claimed to save the economy by injecting more money. But every rescue reinforced the same architecture: increasing dependency and shrinking freedom. Rather than weakening the system, crises made it permanent. Fallout: the invisible cage. Today, most money exists only as digital numbers backed by promises of future labor. Nations owe trillions. Citizens work longer for money worth less. Inflation silently taxes every breath, yet the system demands participation. There is no alternative economy large enough to replace it. Leaving means exclusion. Staying means submission. Failed fixes reforms that never worked. Governments tried regulation, transparency, oversight. None touched the core mechanism: debt-based money creation. The root was never repaired, only cosmetically adjusted. The machine kept running. Modern parallels, patterns repeating. Global debt now exceeds $300 trillion. Real wages stagnate while asset prices soar. Wealth concentrates at historic extremes, and every solution offered creates more debt. The design reveals itself clearly, not a mistake, but an architecture. 3 takeaways. Central banks do not just manage money, they define the rules of reality, not a temporary flaw. Escaping requires awareness, not blind participation. Warning: final thought: if money itself is built on obligation, who really owns your future? And if the system cannot survive without your dependence? What happens when people finally understand the design? Natural call to action. If you want more deep dives into the hidden mechanisms that shape your financial reality, subscribe to the channel and turn on notifications. So once you see the system clearly, it can no longer control you the same way.